Then you begun the second wave of the bull market where you begin to get more institutional acceptance. You know, people no longer look at you strangely if you mention the word gold in professional circles. I mean, certainly with people like George Soros, John Paulson, Greenhorn funds, a lot of the big, what I call fund managers or hedge fund managers are going in that direction. But it's usually in that third phase when it really goes wild. And I think, Nick, back to the years 1970, 79, 1980, when the public was lined up around street corners cashing in their silverware, or in the stock market, it wasn't until after 1995 that the public came in full force, and almost 90% of the money that came into the stock market by the public came in after 95.
Well, that's right. The difference in this case is I don't see it as, in terms of price of gold as a traditional bull market, because, in a bull market, it goes up, eventually peaks, and then goes down. What we have is a global currency debasement that isn't going to get corrected. What's going to happen if you look at any of the other currency debasements, it debases for a period of time, and then you exchange your $100 trillion note for a new $1 note, is how they all go. You're not going to get a kind of a bull market followed by a bear market. In 1980, Volcker was able to do a number of things where that bull market at a rising price of currency debasement in primarily U.S. dollars was reversed. But none of those options are available without a complete currency debasement and the issuance of new currency. I don't think in this case. The debt situation and the liabilities and so on are so large, there is no way out. They can't possibly be repaid.
Yeah, some of the other things that strike me as being different is not only is this bull market more universal in its scope, it's not just the U.S., it's China, it's Latin America, it's Europe. And then I think also, Nick, wouldn't you agree that there's fewer alternatives? As I mentioned earlier, there were a lot of hard currencies tied to gold in the 70s that one could go into. In fact, it got so bad for Switzerland that if you put money into Switzerland, the Swiss used to charge you actually negative interest on your account. They would charge you for keeping money in a Swiss bank.
That's right. Well, that was their current move to discourage that becoming a condition again. So, but that's where I think if we look at the current situation as a currency debasement and look at what's happening to the currency, it becomes clear that gold isn't in the bubble. It's the currencies that are in the bubble. They don't appear on the surface to be that.
Well, Nick, in this kind of environment, it seems like they occur at $100 marks. Gold hits $1,500, it's a bubble. $1,600, it's a bubble. $1,700, $1,800, $1,900, etc. They seem to occur in $100 increments. At this point, rather than trying to second guess, like on the day you and I are speaking, gold was down, $50, $60. Rather than trying to second guess that, what would you advise right now? What looks the cheapest to you? And if somebody was new to this area, where would you suggest they begin?
It depends on the level of wealth and what the objectives are, because if you're very wealthy, then it makes sense to diversify amongst sort of the three monetary metals, gold, silver, and platinum. And you may also want, junk silver bags, for a certain amount of kind of insurance in terms of, physical bullion. If you're not so wealthy, then obviously the place to start is with silver eagles or silver maples. And if you have sort of medium area, then I would just dollar cost average, take an amount that you can afford and buy it every so often, whether it's weekly or monthly, because trying to time the market is extremely difficult. Like we've had a big down day today. I mean, tomorrow could be the exact opposite, and we could, surpass the previous highs for all we know. It's a very hard market to predict in time, and from what we've done of kind of technical analysis on bullion, is we found it hasn't worked as often as it has worked. The charts show one thing, and then they just do the opposite thing so many times just because of some announcement.
And that's one thing that I've certainly seen in this market, that the movement of gold is frustrated a lot of very prominent technicians. You think it's going to go up, instead it goes down, or you think it's heading down, or there's some kind of pattern, a head and shoulders pattern, and it doesn't play out. I mean, I have seen more technicians actually regret where they're trying to make a call, I would sell gold here, I think it's topped out, only to see gold go up even further.
Well, it's really the same thing, because if you're trying to apply technical analysis to junior mining stocks, it also doesn't work, because all it takes is one decent-sized investor. He can move the charts any way he wants. And it's the same thing in gold. The classic example that I can think of off the top of my head was when India announced that it bought 200 tons of gold, all the charts were pointing down. And as soon as it made the announcement, it reversed big time and very fast. That just happens because of relative size of the markets in both junior mining companies and in gold. A major buyer can move it in an opposite direction, buy or sell.
So to sum up, if you are wealthy and have the means to diversify, then you would recommend taking positions in gold, silver, and platinum. If you have, let's say, lesser means for investing, then probably a good place to start out would be in the area of silver, either with junk silver or something like silver eagles or silver maple leafs.
Yeah, because with that, no matter what, just about everybody can afford, one silver coin a week or a month, that type of thing, and then at least you've got some build-up, and eventually you'll have some protection. If you're doing that over the last 10 years, you'd be in very good shape right now.
So, Nick, what about investing in funds that own bullion, for example, like what you do with the Millennium Bullion Fund? Talk about the advantages of that.
Well, it's simply meant, again, for smaller investors, because our minimums are $500, and you can set up what is called a PAC plan, where you have a monthly deduction, right from your bank and so on. So it's affordable by small investors, and we hold all three metals in one fund and gold only in another fund. And then for wealthy people, we have the ability to buy the investment-grade bars and have allocated insured storage for them. So we offer both of the product. We don't sell coins or wafers or anything like that, but we do the fund and the bullion bars product.
All right. Well, listen, Nick, as we close, if our listeners would like to find out more about your work and Millennium Bullion Fund, how could they do so, please?
Well, simply they go to the website. It's bmgbullion.com.
All right. We've been speaking with Nick Barisheff. He's president of BMG Group. Nick, I want to thank you for joining us on the program.
My pleasure, Jim. Thanks for having me.
You can subscribe to Financial Sense NewsHour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/Financial Sense Online. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense NewsHour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the NewsHour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Puplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the NewsHour. Be advised that you invest at your own risk.